Okay. Okay, so the market is made up of N bounces and V bounces. Okay, the market is made up of N bounces and V bounces. Let's take off this indicator. We don't need it at this point. Okay, we don't need that indicator. So now let me prove that the market is made up of N and V bounces. What do you see? Sets of N and V's. All right, sets of N and V's. These N and V's don't just happen because they want to happen. They happen due to some particular reasons. Okay, and they signify reversals. Okay, they signify reversals. So when an end bounce happens, the trough of that end bounce is called a resistance. Okay, when a V bounce happens, the base of that V bounce is called a support. Okay, so now they show reversal. The market was going up at of this point where you see my mouse, and then it's obviously started coming down. So it shows reversal. The market wants to reverse downward whenever you see an N. Okay, whenever you see a V, you know the market wants to reverse from it's coming down, but it wants to reverse upward. So we are to catch this. That's bearing in mind that you know the characteristics of the market. Whenever it wants to form more, it forms N and V's in support and resistance areas. Okay, it cannot just on its own form N and V's like this. It forms due to some particular orders, demand and supply, or whatever. So, but most specifically, where it is like 70% chance that the market will form an N or a V, that's a reversal, it's in support and resistance area. So now we are not going to be using this to trade. I want to show you what we are going to use to trade. So we'll use our candlesticks, okay? These are our candlesticks. So now looking at this is where we do our analysis on trading view. We're doing the analysis on the 4 hours time frame. 4 hours what time frame, and we are doing it on Euro US dollars. That's the currency pair that we are doing. So now let's just go back to any time in the future, in the past, since we are doing a back test or so. So now see, this is the data we have. Okay, this is okay. Let me just go back. Let me just go back anywhere I want. Okay, now see, let's start analyzing price from this area. Okay, or let's go anywhere I choose. Okay, let's start analyzing price from this area. Okay, now looking at this. Okay, how N and V bounces are on the chart is not how they are on the line chart. Let me explain that. Now, if you see a red candle, please listen attentively. This is like one of the most important parts. Now we have something like this. Now let's say we have the red. So okay. Let's say we have a red candle, okay? I need to really identify this. It's supposed to be red. Okay. No problem, I know what to do. Okay, yeah. So here you go. Trying to illustrate something. Okay, let's say this is a green candle. Right, this is a green candle, okay? Right, and then we have a red candle. Right, so now whenever you see something like this, a green and a red, this you notice that the market was going up because green signifies up. Right, this is all symbol. Every color you see in this market is symbolic. All right, so how this chart was designed, whenever you see a green, you know the bulls are in control, so it's bullish. Okay, so now we saw a green candle formed. That means it was bullish for the whole of this fall because it's 4 hours time frame that we are working on, right? So for 4 complete hours, the bulls were in control of the market. Okay. Now for the next 4 hours, the bears were in control of the market. That's why we see a green and a red. So therefore, the up that the market came up. That's if you now want to be logical. The market went up and then came down. So it reversed. So this is an end bounce. All right. This is how you know an end bounce. This is an end bounce. Let me state that this is an end bounce. Okay. All right. This is an end bounce. Have you seen it? Now, if we have a scenario like this, where we have, let's say, a red, and then we have something like this, a green. What kind of bounce is this? Eh?
V bounce
Why is it a V bounce?
because it was coming down
Mm-hmm.
and going up.
All right, symbolic, right? All symbolism. So now we see that this red candle signifies a down, and then this signifies an up. So it's a V bounce. You see, so this is a V bounce. Let me just quickly state that. So this is V bounce. Okay, so that is what it is. Let's just have another look at it. In this scenario, which we have a resistance scenario, okay, the market was going up, suddenly came down. All right, now the market was going down, suddenly it's forming a V. All right, but this is how it will look like. All right, so now when we are trading an N, all right, this is what we are looking to see. We want price to break this, the top of this N. That's the top of this N, this very top. Okay, you want it to break this. Okay, when we see a break, because I'm going to be teaching you break and retest. Okay, we want to see a complete break. When I see break, I want to see market close above maybe this zone or it's weak. Understand? So now I would just simply get my tool, or I'll click on, that's my line tool. It's my line tool. Alright, this is my horizontal line. Okay, I'll place it here as my resistance. Let me draw this. So this is my resistance, the top, because the market came up and was resisted. Alright, this is my support. Why is it my support? Let me Now this is my support. Why is it my support? The market came down and was reversed upward. Right, so it's my support and then it's my resistance. Okay. Now this being a resistance, what are we looking for to happen in a resistance? We want to see a bullish candle, obviously because it's a resistance. Break. Alright? Break. And then we want to see a bearish candle come and retest. Alright, that is break this zone. This my zone. I'll show you how to do the zoning. This is a break, and I want to see a bearish candle. Oh yeah, come back to retest.
Come back to that.
Come back to this zone. Any area. You know, this is not just a straight line. This is zone. Okay, when a bearish candle come back to this zone, we want to now see bullish momentum coming back to the market, and we enter for a buy. This is what we want to see. Alright. Now, this was the zone. How do we get the zone? N. Okay. N. Right? That was how we got the zone. Now we saw a break of that zone. Alright, we saw a break of that zone. And now we now saw a bearish candle, that's a down candle, coming to retest that zone, to reinforce that zone. And then we saw bullish momentum returning to the market. So when we saw the bullish momentum, what do? We entered for a buy. And then most times, that's like 60 to 70% of the time, which it's 100% okay, you are going to be profitable doing that. That's it. So let's look at what happens in a V. Usually, what happens in a V, we are hoping to see a bearish candle break. Okay, it's just the opposite of this, obviously. Break, all right, and then we see a bullish candle come back to retest. Okay, come back to retest this zone. All right, and therefore, what are we waiting to see? Bearish momentum continue. So we have break and continue, break and continue, break and continue. You understand? Break and continue. That's what we are doing here. Right? If you can understand this, we are good. Right? We are good to go. So this is what it is. Any question? Any question so far?
No question.
100% understood. Can you explain this scenario? Can you explain this scenario as quick as possible, please?
Okay. Yeah. These are M bands.
Okay.
For us to check our resistance zone.
All right.
So we're looking for a bullish candle
To break.
to break that resistance zone. Then after that bullish candle, we need another
Bearish candle to come back and retest.
to test on that resistance
Yes,
zone.
to reinforce it.
So after that bearish candle has tested on that
and
resistance,
showed rejection. Most
Okay.
importantly, we want to see that rejection, because
So-
if it breaks, I don't know if you understand, then it's not more valid. It's telling you that it could not hold.
yeah, so after
Alright.
that red candle, if you
Yeah.
can see any green candle,
Yes,
the
form.
best thing for us to do is to buy.
Good. All right. Now, how about this scenario?
Then yeah, this is V bands
Right.
to check our support zone.
All right.
We
Sure.
we need to look for V bands because this is V bands for us now.
All right. Sure.
Then after that V bands,
Why is it a rebound? Sorry.
because it was going down
Alright.
initially and went up again.
Good.
So if you have another bearish candle that retests,
Breaks. Yes.
that breaks that
zone.
support zone,
Sure.
then after that, if you
We're
can,
waiting for-
we are waiting for a bullish candle
All right.
to bring it back, to leave that
That's
break.
to come. That's after this broke, the candle that broke the zone has
Yes.
closed.
Yes.
We're waiting for a bullish candle to
Bullish
come back
candle
and retest.
and retest.
All right. This is even wrong. So we're supposed to be retesting here like this. All right, because this is the zone. You understand? You're right. You're right. You're good. Okay. And then continuation.
So if you can get another bearish candle after that
Yes.
green one, so the
You can
best thing
enter.
you can sell.
Good, 100%. So let's continue. Let's go to the live chat and do what we do. All right, now. So see, have you seen that scenario? What kind of bounce is happening here? In your opinion? What kind of bounce? We see a bullish candle and then
because this is a bullish candle.
all right, all right.
Bullish candle, it means it was initially going up
Yes.
for the first 4 hours.
Mhm.
Then we saw another red candle. That means the second 4 hours it was
Mhm.
going down. So this is end bounce.
Good. End bounce. So what do? We just mark the zone. Let me teach you how to mark the zone. Now, if you want to mark the zone, all you just simply need to do is carry this, your tool, you place it at the top of that's the head up top, all right.
And
Then now
bounce.
that's your then you now take another one. That's to get the zone. I like getting the zone and look for the longest week. This is the longest week. This week is so short. You see, this week is so short. We will not count that. We'll take the longest week. So we'll put it here at the longest week. So that's our zone. So price can come anywhere into this zone and do what? Reject. It can come.
Please, what's the peep that we can use to?
Don't worry, just forget about that. The zone can be as big as 100 pips, can be as based on the time frame you're doing. But what made me to get that zone was that I took from the body. That's the tip. That's where their heads
Of the
are.
inbounds.
You understand? That's this zone, this place. Let me zoom in so you see what I mean. Oh my God, what have I done? Where were we? This is what's okay. This is where we were.
Yes.
Yes, yes, that's where we were. So now, have you seen? This is the tip. We have the tip and the wick. All right. Now, let me just draw out what is happening there. Let me just draw out exactly what is happening there. We would use this tool. Okay. Now we have something like this. All right. I want to draw out what I'm seeing there. I don't know what if you are seeing a different thing. Okay. I want to draw out what I am seeing there. This is what I'm seeing. Something like this. Okay. This is a bullish candle, representative of a bullish candle, and then we had something like this. This one. All right. I'm drawing out what I'm seeing there. Hope it looks perfect in a bit, right?
Yes.
And then we have something like this. You understand? Oh no, it's supposed to be like down here. Okay, and then we have a long tail. Yes, 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 yes. Those people that do candlestick analysis, they will say this is a bullish, a pin bar, or whatever. Forget about that. It's important anyway, but it's not as important as knowing what is happening. Yeah. So now we are taking from the body. You see this place. This is where the bullish candle closed, right? Because I remember from our previous classes that bullish candles open from down and close up. Now bearish candle open from where that bullish candle closed, all right, which was here. It went up a little bit, but was not sustained, and then came down. All right, it even went as down as this. That's why it has a wick, but closed there. So this is a bearish candle. This is a bearish candle, and then this is a bullish candle. So they had the open on the under, and then we have the close at the top. So exactly where it closed, this one opened. So now we are taking the close. That's this up side of it to be Alt H. Have you seen it? That's to draw our zone. And then I'll take it to the highest. If this was the highest, I'll take it here. But this is the highest. So now that's how I got my zone.
Alright.
Right? Perfect. So we have gotten this zone. Market can come anywhere around this zone. Even comes like this. But if you reject this zone, you enter for a buy when you see right confirmations. You understand? So that's what I'm trying to say. So now we have been able to get this. We have been able to get this. And that's our zone. You know how we draw our zone, no? Okay, let me just try. Let me just try it out. Can you just draw the zone out? Draw the zone. Draw the zone. Use
Alt H.
Yes, Alt H. Is that how it is on normal computer?
Yes.
Okay, Alt H. Good. That's how you get your zone from body to the toppest wick of the two reaction candle or whatever. From body to the toppest wick. So now, have you seen the break?
Yes.
This was the break of that zone. Now see the retest. This was not even a retest. I don't consider this was the one that was the retest because it was a down candle.
Okay,
And then what do we see? Bullish candle.
candle.
What do you do? This is where you enter. So nobody will ask me where do I enter. So after you see this candle close, Baba enter. And then after you enter there, now your stop loss can be either here, depending on whether you are aggressive also. You can put your stop loss here or below the V. This is a V, right? I hope you know this is a V.
Yes.
So we had an N. So that's when we talk about the law of support and resistance. When an N is broken, if you see the relevance of our last class, see relevant. When an N is broken, it becomes a V. All right. So now this is the continuation pattern for the V or whatever. You understand? So now this is how we are going to do. I use this tool to determine where we enter. This is where we entered, and our where we are placing our stop loss. You understand? And then where we will place our take profit.
Sorry, what's the name of this tool?
It's just here. I don't really know the name is, but we have long and short positions. They are our position tool. they just represent. But I can do that with a line. I could just say, okay, this is my entry at the close of this candle. So I draw a line, Alt H, okay, and then this will be where I'll put my stop loss. I say Alt H again. You understand? Alt H on that zone, and then I say, okay, this is where I'll put my take profit. So your take profit has to be two times or two times exactly two times.
Your stop loss.
Yes, around two times your risk. Alright, so if you are aggressive and you entered your stop loss is here, alright, you are going to measure. That's almost after you must have placed your trade. So I'll measure from here. I'll come here like this. I see this is 35, right? So 35 plus 35, so because it has to be two times. 35 plus 35 is what?
That's 70.
What? 70?
No, 70.
Okay. Yeah, you're right. 70. So now, because it was 35, now we are looking for 70. So you see, now at 70, that's where our take profit will be. So easy. So this, if you are aggressive, so if you are not this, you place your own here. That's if you are defensive. We have this, and then now your stop loss would be this would be 50. Now you're looking for 100, and this was where we got our 100. Have you seen it? You got your 100 over there. You understand? So what lot size are you going to use for this trade? This is how I determine what lot size I'm going to use for a particular trade. I go to my FX book or any of our risk calculator that you have been taught. I determine what percentage of my account do I want to risk. Most importantly, advisably 1 to 3% of your account. Always 1 to 3% of your account. But as learners, always risk 1% because you're going to be making some mistakes. Alright, so I say I have a $5,000 account, 1% of my account. What's the stop loss? So it tells me the lot size I'm going to use. Okay, now let's say we took this trade. Okay, so now we took this particular trade. So now from our entry to here, it's about 50. It's about 52 pips. 52 pips. Yeah. So we are looking for 104 or so. All right. So which is around here. All right. 104. All right. So now 52 pips is what we are going to put here. We'll put 52. We are risking 1% of. We want the range of 52 pips to be what 1% of our account. So if we lose that 52 pips by the lot size, this is going to calculate for us. We're going to lose 1% of that account. 1% of $50,000 account is about $50.
$50.
Exactly. So now we have 52. So now, what currency pair was that? It was the Euro US dollars. Okay. So we have the Euro US dollars. So the currency pair is Euro US dollars. So I'll just say Euro US dollars. Okay. Euro US dollars. Where is it? Yes, that's it. So now we have 0.96. This is what you are going to type in your lot size place. 0.96. Alright. For those of you that are watching, what you need to do is that if you don't understand, always go back to this video and simply refresh your memory. Okay. So now looking at this. Okay. We now have. Let's say you place your stop loss here. It will have. Okay. Let's say this is if you had placed your stop loss below here. That's below the V. You understand? If you had placed your stop loss below the V, this would have been the lot size that would be 1% of your account. But what if you had placed your stop loss, you are aggressive, and you had placed your stop loss below the trigger candle, which is about 32, alright, which is about 32. So if that was 32, everything remains the same. $500, risks 1%, it must be 1%. Euro US dollars, currency pair, calculate now. See, it's higher, 0.156. You see it, 0.156. 0.156. I don't know if you understand. Okay, that's what it is. Alright, so 0.16. Oh god, that was. So you basically understand now how we got what we got, right? You basically understand how we got what we got. So now this, because of this range, okay, because of this range, we got, you see, different lot size. This one is 0.096. This one is 0.156. All right. So if you lose these pips, that's this way your stop loss will be. If you lose, as the market comes down and hits that level, you have lost the same amount. This is the same amount based on where you placed your stop loss. If your stop loss was here and the market came there and hit that place, you have lost this. Which one? Yes, this one. because that was the calculation. It calculated it automatically for
1%.
you for 1% of your account. But if it comes here, it's still the same amount you will lose. But you see, this was lower than this. It was lower than this. So that's just the idea. So now your this one is where you want to take your profit. So now this was a winning trade. So you took your profit here. You took your profit here, which is very good. All right, one is to two. I mean, you're risking 1% to get two. Is that not perfect? It's perfect. All right, so that's how you take a trade. So now you can also use this tool. This tool, you come here, you get the tool. We have long and short. When you want to take a buy, it's a long. So you place it where you want to enter. All right, then you take this to where you want to place your stop loss. All right, it does the maths for you here. This is one. That's 1:1.5. All right, that's risk reward. Risk is one, always one, or whatever you are risking. Maybe two. Two is to what? Now, this is 1:2. Have you seen it? It's telling you where two will be. I'm looking at here. Oh, if I drag it down, it's tell you that's 1.8. But yeah, this is 1:2 for me. You understand? This is 1:2 for me. You understand? 1:2. Have you seen it? Around. Let me. Or what I just simply do is that I come here, do the calculation. 507 times two. That will be whatever that is would be 1:2. Okay, it's not that. It's 20 or so. So whatever that is, okay, it's not 20. It's let's see, 19. I just want to get direct figures. But it's not. Let's say 18. That's two times. If you have a calculator, you could do it. 507 times two, whatever it gives you. That would definitely be 1:2. Listen, it's 1:2. So it's you from here, your stop loss range to here. Right? If your market comes, you lose. But if it went in our direction, so we win. All right. So now you are risking 1% to get two times. So doing that, you have a better chance of success than someone that is just taking trades and is risking. Maybe when he loses 1,000 naira. When he wins 100 naira. Is that person going to be successful in the long run? No, it's not. Why? Because he's losing more than he's gaining. All right, so that is how it is. So can you just look for an opportunity and tell me what to do? Let us look. Okay, let us quickly check a sell opportunity. Now this is a sell opportunity. See what happened. This one is even a longer one. Sef. You see, I will basically take from here. That's the body. Obviously, you know why. To my longest week. Okay. Now market has broke that, and we now see an up candle coming here to reject. All of this we did not take, but over here we took. If you had used the aggressive, you will have been stopped out. But you use this one, or is it? No. Okay, you'll have been stopped out. Let's say you lose that. Now you come back again because you now see an up candle coming to reject in this zone again. Okay. What do? You enter for a sell when you see a down candle. Another thing that I use to enter for a sell, but maybe much later I'll teach you, is that I place my. That's if I've seen an up candle, for example, I place a sell stop down here, a sell stop, so that if the market does this kind of long momentum movement, I get triggered into this trade. So basically, I will have my entry here, that's a sell stop, a pending order, and then I have my stop loss here, so that if momentum pushes this market downward, all right, I'll be triggered in and it hits my take profit at 1:2. Don't even understand. You understand that?
Please explain it.
Okay, I will definitely. So now we have our zone. You know why we entered? We are entering here for a sell. The first time it happened, the market came here and reversed. Okay, it came over here and reversed, and then this was our signal to enter for a sell, right?
Yes.
Because it was an up, then we have it down, making an N. Right? So we were supposed to enter here for a sell, but we entered here for a sell quite alright. But we lost. Why did we lose? Because we must have placed our stop loss over here, up here, also. So this cleared us out because the stop loss was so tight. But however, it now came back and it still say this zone is still reasonable, it's still strong. You understand? And did not break the zone. It did not come and close above this zone. Because if it had done something like this and closed above this zone, it has broken the zone. You understand? So it still came back and rejected. You see these wicks? These wicks are very important. They are called exhaustion. Alright? Exhaustion. Very, very important. When you see exhaustion, it shows rejection. That this thing wants to hold. It's telling you that they were trying to go up, but they don't succeed. They tried to go up, but they don't succeed. They tried to go up, they don't succeed. You understand? Telling you that, oh boy, find where to sell, find where to sell. This thing won't sell, it won't happen. Now you see momentum now sets in and triggered us. So there is a way I will have entered this. I will have put a sell stop down here, or maybe I'll have put a sell stop down here. You know, All of those kind of things, so that if the market comes and triggers my sell stop, I'm inside this trade. Like in this scenario, I would have caught all this movement. But however, if that's too hard for you, don't worry about that. We'll get into that. But you understand basically what happened here, right? Yes, that's what I want. I want you to understand right now. So now, let's say we have this as a zone. All right. Now see, we have this. Okay, that's not a good example. Okay, now see up, down. Okay, don't like that one. But this would have been a good opportunity, but for advance anyway. So let's just look. This is your kind of traits. We have a good. Okay, is this good? This is good. Good. Okay, I think it's somewhere here. But this one, it's yeah, it's kind of good. You understand? So our V is there. This is our V, right? Even over here, this is it. Now we have okay. Draw out our V, our zone. Draw out our zone for this V.
With these two,
Yes, for this no, for this one. Where do you see your N or your V? Draw out our zone for the V. Draw out our V. Notice, yes. Notice that this was a down candle. Be always vigilant of that. Yes, always hold hedge if you want to. Okay. Now, where is the longest wick? Here. Good. So now you have a zone. All of this has not happened yet. Oh. Take note. All of this has not happened yet. When you were drawing all of this, whatever you are drawing, this has not happened yet. So now, market now broke this our zone that we have drawn. We are now waiting for market to come back and retest. So market came here and retest. Okay, we did not do anything. It shows that this zone is active. Or let's say we're the people that used to put our stop loss here. The next candle did not trigger us in, right? Next candle did not trigger us in. So we now put our this thing here again. Okay, we put our this thing here again. This next one now triggered us in. So we are inside this trade. So if we had put this here, we'll have had something like this rigs. We'll have had our entry here, our entry at this level 1.23028, and then we'll have had our stops above here. That's if we had used a sell stop. But if we haven't and we had used the normal thing that we do, wait for this candle to come back, retest, and come and close around here. Alright, this will have been our stop loss range. That means here will have been our entry, and then here will have been our stop loss, and then this will have been our reward or whatever. So 1:2. Alright, 1:2. You know how 1:2 is done, right? You know how 1:2 is done. We say what is our we measure these are measuring two. These are measuring two. Take note. So we place it at where we entered to where we have our stop loss, which is 22 pips. We calculate it using our calculator, and then since it's 1:2, 22 times 2,
that's
that's 42, and we have our 42, which is profit for us. Don't even understand. Very good. So that's where I want us to stop. I want you to go practice, work in the road. At least next class you understand exactly what we are doing. Good, right?